I think the first thing to recognize is SPACs are not new. They've been around a long time, but they've come and gone. They've been abused in the past, so they've kind of gone away. So in the newest iteration, SPACs were created with downside protection, which is investors in SPACs could pull their money out if they felt uncomfortable. They could pull it out before the deal got done. They could even pull it out if they didn't like the way a deal was structured. So that was the protection investors were offered. The only problem with the SPAC is you're outsourcing your thinking and you're choosing as an investor. You're letting a celebrity, a big investor, make your choices for you. And in return, that investor takes 20% of the funds raised. That 20% is the killer. When you leave 20% of the table, it's very difficult in investing to actually walk away a winner. And I think the market's catching up with SPACs. And I think what you're seeing here is a recognition that that slice is way too large for SPACs to survive.
And now you've got some people blaming SPACs for the week's sell-off that we've seen of late, basically putting the blame on these SPACs. Do you think that SPACs are a big reason for taking down the stock market?
Absolutely not. This is like blaming a wave for creating a tsunami. So SPACs are a tiny, tiny part of the market. The subset of the market where they are has been affected, but it's been affected because tech companies went through a rocky couple of weeks. So I think to blame SPACs for what's going on in the market is completely missing the mark.
Do you think this is the end of the SPAC then?
I think it's the beginning of the reorientation of the SPAC. As I said, you could design a SPAC that actually makes sense. The sponsor, who's the person putting the SPAC together, can't take 20%. The deals, I think, have to be, investors have to think for themselves. They can't just dump money into SPACs and expect them to find great deals. And as the market gets tighter, as deals dry up, SPACs are going to dry up as well, not because they don't work, but because there aren't enough deals to be done.
I want to move to the idea of valuations here because we're seeing the Russell 2000 index, that's the index of small companies. It's fallen into a bear market, 20% down from its record close in November. Have investors lost their appetite for stocks of unprofitable companies, which I think a third of the Russell 2000 are the companies are unprofitable, but isn't that the very thing that makes the stock market go round? Is that the idea of risk and looking at growth of a company?
I think we need to take a longer term perspective. It's true the last couple of months have been tough, but if you step back and look at what your portfolio has done, if you had young growth companies over the last 5 years, the last decade, you've had a really good run. And the history of markets is when you make money that easily, you got to give up money that easily as well. So I think some of this is the correction towards what I think is a more reasonable number. I think it's too soon to pass judgment and say investors have lost their faith in young money-losing companies, because you're not seeing a flight of investors into nice, safe, utilities or cash flow generating companies. So I think it's less of a rotation and an overall market correction that you're seeing.
Okay, Aswath Damodaran, finance professor at New York University. Great getting your perspective today.